It's a big day for Standard Bank on the release of financial results. Chief Executive Sim Tshabalala, lovely to have you in our virtual studio, Sim. I see the share price moved down today. You deliver record results. Shares go down. I guess it's because you've had such a good run since mid-July.
Alec, thank you so much for having me. And that's a lovely thing to say. I don't know what's going on in the market today. I haven't actually been following the news today. But yeah, we released a reasonable set of results. I'm sure you would agree.
Well, up powerfully across the board, 33% headline earnings. You can't really ask for more than that. But I guess the main issue now is Standard Bank ahead of where you were pre-COVID?
Yes, we now are. We almost by every measure you can think of, whether it be net interest income, non-funded revenues, we are ahead of 2019.
I see you've got a 2025 commitment, and we'll talk about that in a moment. But you've been running the bank now on your own for quite a long time. I recall you had a joint position with Ben Kruger. How much have you learnt in these years? Because I guess the longer one's in a job, and especially when you were pretty young when you came into it, the more you get to feel or hit your straps.
There's no question that one learns, and one learns every single day. I mean, even today, I can tell you that there are a couple of things I learned from questions that people were asking. And I suppose also as you get older, I think, develop a little bit of humility. And you also develop, I think, resilience. The last few years have been particularly difficult. And learning how to manage a massive institution in the middle of a 1 in 100-year crisis you learn a lot.
How many people work for you?
Just shy of 50,000.
That's extraordinary. And one of the highlights of this set of financial results was what's going on in non-South African assets in the rest of the continent. If you go back to 1992, I well remember that acquisition that Standard Bank made there of ANZ Grindlays, of its African network, and you've really turned that to account. But I was surprised to see you're getting well over 1/3 of your headline earnings now coming from other parts of Africa. What's the natural number?
I think, so they make up now 41% of this year's half year's numbers. I think the natural number is probably going to be higher than half in the fullness of time. But I think South Africa is just so big, and momentum in South Africa is just so huge at the moment that if I retired and we're still below 50% in Africa regions, it would still be a big number. And of course, as you know, Alec, the thing is a portfolio, right? In some years, the West region does significantly better than the East, which is our food and oil importers, whereas the West are oil exporters. This half year, however, actually, each of the regions, East was up 41%, 46%, South and Central was up 36%, West was up 45%, and then, yeah.
Those are proper numbers, however you want to look at it. I think that a unique advantage you have is that you've got the finger on the pulse, not just of what's going on in the economy in South Africa, but the whole of Africa, given your network there. Just take us through very briefly, what is happening from your vantage point? What's happening on the ground in this continent, starting with our home country?
Alec, I would say that across the board, everybody is suffering the effects of increased inflation and therefore increased interest rates. That applies to everybody. Secondly, some parts of the continent, I think, are facing the prospect of famine because of shortages of food. Definitely the oil exporters, as I was saying, are getting the benefit of increased oil prices. In the case of South Africa, as is the case with a couple of other African countries, whilst we are importing oil and the oil price is elevated, we also export coal. And the price of coal has accelerated faster than oil. The consequence of that is that we've got positive terms of trade. That's good for our GDP. It's also good for inflation, and it's therefore good for interest rates. So it's a fascinating period, I think, in our lives. Africa is still, we believe, the place to be invested in. We still think that it's going to grow faster than the rest of the world, other than perhaps East Asia, and that Africans will continue to get healthier, wealthier, and with greater disposable income. We're facing a number of elections. You've been watching what's happening in East Africa. We've got elections in the ruling party in South Africa in end of this year, prospect of elections in 2024, and then you've also got elections in Nigeria next year. So democracy, I think, is going to be a big feature of our lives, and the question is going to be stability as those elections happen.
Is democracy good for you, for a bank like Standard Bank? In other words, the spreading of democracy. We've seen what's happened in Malawi, Zambia, perhaps Zimbabwe soon. Who knows? We're looking at coalition government probably here in South Africa 2024. Is that a good thing for Standard Bank?
In the long term, I would argue yes, because it provides you with certainty and stability. We trade, for example, on the basis of the rule of law. We've got a great constitution. If people respect our laws and they respect the competitiveness of a democracy, it's good. And in fact, the more competition there is, the better it is for society. It applies, Alec, as much in politics as it does in business. You know, competition between the banks is good for consumers. Competition in politics is good for politicians because it holds them in check.
I've got quite a close relationship with your guys at Shift and also with PowerPulse, which was a very innovative operation that Standard Bank put together, a digital platform for renewables, again ahead of the mark. On both of those, they seem to be doing really well. But from an executive point of view, you're sitting there in this massive group with 50,000 people who work for you. How do you decide as an executive how to allocate resources?
We decide at the highest level to say we are going to allocate our resources, our capital, to those parts of the business that are going to generate the highest returns. That is firstly Africa regions, because of the point we were debating earlier on. Africa is going to grow faster than South Africa. Secondly, we want to allocate it to those parts of the business that generate the highest return on equity, particularly those businesses that are capital light, is the jargon, I guess. So in our case, it would be places like insurance, asset management, and so forth. And then thirdly, we are wanting to increase the number of our clients to address the question around Shift. We want to improve the customer experience, and we want to beat the new entrants, the fintechs, the big techs, the small banks, and the incumbents who are becoming fiercely competitive. And the way to do that is by either partnering with other fintechs or by buying them where it's appropriate. And if it's appropriate, we'll then allocate the capital to do that.
It's an interesting time, as you were saying, for the content, but also in that area, because the fintechs we've been hearing for many years have been threatening to take away, to eat the lunch of the incumbents like yourself. Are you finding that this strategy of creating your own fintechs or buying them is working, is paying off?
Like, I think we've chosen an eclectic approach to it. If it makes sense, we will partner. If it makes sense, we'll take a minority position. If it makes sense, we'll buy the entire thing. I have to make a general point, though, which people may disagree with. There was a time when you would be right. They would eat our lunch, or they were going to eat our lunch, where particularly in payments, particularly in wallets, in certain parts of investment banking. You just now were debating with somebody about buy now, pay later loans. People providing SMEs with POS devices. There was a time when you thought, they're going to eat significantly into the payments business. Now, increasingly, it appears that as money is becoming more expensive, patient capital is no longer as patient as it used to be. people are also discovering that banking and payments and banking in general is a scale business. Fortune favors the big battalions. They're also discovering that, when regulators suddenly discover that AML, KYC is not being done properly by these peripheral players, they want to regulate them like they would be regulating banks. One regulator said, if it quacks like a duck, walks like a duck, it's a duck regulated like a duck. And I think many of these players will find the need to either partner with others because of scale or partner with others because of the need to be compliant with the heavily regulated environment. That then draws you to the conclusion, if I'm right, that your biggest threats are incumbents who become nimble and beat you at this game. In our case, it's ladies and gentlemen in turquoise, in red, and in green.
You mentioned regulations. What about crypto? What's your view at Standard Bank on the regulating of crypto, or indeed the unregulated markets that we're seeing at the moment?
I think that the simple answer is, if you just go back to applying distributed ledgers to financial services, it's the way the world is going to go. And therefore, regulators who are sophisticated are going in that direction. The South African regulator is applying its mind to easing regulation and allowing it. We're in a position to take advantage of that happening. So I'm in the space that says, if this is good for clients, it's appropriately regulated, then we must all go for it. And the South African regulator is quite sophisticated when it comes to crypto.
I had a fascinating chat with Kokkie Kooyman after the Absa results, and he was talking about Absa's rebound since the exit of Barclays. And he reckons, now it's an interesting commentary here, so I'd love to get your insight on it. For as long as I've been covering banks, it was always a two-way race between Standard Bank and First National, or the FirstRand, if you like. Standard Bank would be ahead for a period of time, and then FirstRand, and then it would reinvest, and FirstRand would go ahead, or the old Barclays as it was. But Kokkie reckons that Absa are now starting to challenge you for that number 2 slot where you are right now, rather than you challenging FirstRand for the number 1 slot. Set him right. Tell me what you're doing to make him not be accurate.
One has the highest regard for Kokkie, but of course, these are matters about which reasonable people can disagree. Where we do agree, however, and I'll come to the disagreement, is that you underestimate Absa and Nedbank at your peril. In the case of Absa, they've got a fantastic brand. They are undoubtedly champions when it comes to retail banking. They've got a fantastic distribution network. They've got exceptional people, and they've got a fortress balance sheet. With their divorce from Barclays, they've got a great system. They have learned, in my view, a great deal as a consequence of that relationship, and they've got good people. And so in segments, they are particularly competitive. Home loans, for example, they give people a run for their money, and so forth. So the general proposition is, they are a very good bank, but they're still significantly smaller than we are in terms of assets. Their revenues are smaller than ours, but the ultimate measure of the success of a strategy is return on equity. They are beating us on ROE, which drives us around the bend. We are determined to get into that ROE range of between 17 and 20%. By 2025, we think we will get there. But, Alec, one has to have the humility to recognize when people are beating you. They've got a better ROE than we've got.
Yeah, that's that 2025 commitments, that you were talking about.
So where I would disagree, however, is there are certain parts of the business where we are better than they are, CIB, etc. But they are an exceptionally good bank. I hope that makes sense.
It does, but then the question comes of your big shareholder. If you go back to the apartheid days, it was Standard Chartered, and then they divested in 1987 and Standard Bank zoomed. Now you have ICBC, a Chinese bank, which invested here in 2007. I looked at the numbers. They put in $5.5 billion roughly, which is now worth about $3.5 billion. Could you do a Barclays there? Could you buy them out? Could you or is there any appetite from the Chinese? Because China seems to be a very interesting, to put it mildly, partner to have in this modern world of ours.
So, Alec, at the moment, there is no view around ICBC ever exiting us. It's not even on the table and being contemplated, because we still believe that the China-Africa corridor is one which will exist in the long term, that trade and investment will continue, therefore people need intermediation services, and we will be in a position to provide those intermediation services. And so the relationship, the strategic rationale for that relationship continues to exist. What is true is that this is going to be tested because of geopolitical and geostrategic issues. We've done the scenario planning and the scenario thinking. There are three broad scenarios. We believe that the extreme scenario of a thermonuclear war is improbable, war, sanctions, and so forth. What is more probable is increased geostrategic competition, more saber-rattling, and greater competition. The main reason for that is because the world is far more interconnected than it ever was. China exports a great deal to the US. China requires a lot of access to US payment systems. And so the world in that sense is too interconnected for either a war or for sanctions, because those sanctions would be symmetric. If the US and its allies applied sanctions to China, they would do the same. So because of the trade and investment connections, we don't believe that it's probable that you would have an all falls down scenario. What is more likely then is more of this competition. In that context, we believe we continue to make money. We continue to work on our relationship with Chinese clients, with clients from the EU, and indeed with American clients.
So it's a little bit like being in a neutral position, non-aligned, as it were, from a business perspective, but you do have a significant shareholder who is Chinese. Do they play much of a role with you?
Before I go there, Alex, so we've got Chinese shareholders, we've got a large cohort of European shareholders, and we also have a large cohort of American shareholders. The Chinese have got 20% shareholding, and that entitles them, in terms of the agreement entered into with them, to 2 board members. But they are in the minority, and they behave like one would reasonably expect of modern Western shareholders. They comply with the laws and regulations and governance principles that one would expect in South Africa and in other parts of the world. So they don't have a disproportionate level of influence.
To close off with, looking ahead to your 2025 commitments, you're behind the curve on your return on equity, and you've said that that's a priority. That's how you'll measure yourself. How else are you, or how much closer are you getting to those commitments in the other parts of the organization?
So, Alec, if we were to continue the trajectory we're on, if we were to continue, we would meet those commitments. So as at half year, we're on plan to meet the commitments if we deliver what we've committed as at half year, and we continue to deliver on the same basis in the second half. We need to continue to drive revenues CAGR 7 to 9%. We need to get our cost to income ratio to as close to 50 as is reasonably practical. That will then get us to an ROE of between 17 and 20%. And as we speak, we have an ROE of 15.3%. It improved significantly from the last reporting period, and that trajectory continues in that direction.
Sim Tshabalala is the Chief Executive of Standard Bank Group, and I'm Alec Hogg from BizNews.com.